Okay, hey everyone. Bit of a deep dive today, but also a bit of an overview. We're not going to get through this whole thing in detail, but what we're talking about is a three-statement model or forecast, and essentially a big spreadsheet um, that is pretty useful in certain circumstances. Now, what this thing does, it takes some actual figures and then we make some assumptions and we're going to forecast out our financial statements for a number of months or periods. This one's set up monthly. You can do these yearly. But just to tell you what it does first is it's going to produce three statements per the name, right? So it's going to produce an income statement. This is our accounting profit and loss, all our income expenses down to our net income here. It's going to forecast out a balance sheet, so our assets and our liabilities. And really important one as well, it's going to forecast out the cash flow statement. And this is what a lot of people will be interested in. Banks will be interested in this for buying a business. We're going to need to know how the cash is going to work. If we're going to be short some months, what do we do in those months? And so basically, you would use a model like this in a number of situations. One might be you're trying to expand your business and you're going to enter a phase of growth and you want to test how that will impact your cash balances. And, if you're doing a lot of expansion, you're going to have costs incurred up front, and there's often a delay until you actually get paid by your customers or your clients. And so you're just going to model that out because a lot of construction firms can get caught out. They don't do that. You might also want one of these if you are trying to borrow some money from the bank and you've got a business and you need to forecast out numbers. And in this case, this is one I actually recently prepared for a client who is in the due diligence phase or was in the due diligence phase of buying a business, and they needed to know the numbers. The bank needed to know the numbers to lend them some money, and they also wanted to know if they could repay or buy out the old owner over a period of time as well. So those are some common examples of when we would use a model like this. And it's pretty big. So let's just go through step by step. And hopefully we'll make sense of it. So a few notes. Our figures are excluding GST. Typically you'd want a model like that. It's not exactly correct from a cash perspective. You obviously collect the GST and then remit it to the tax office at the end of the quarter or the end of the month. But for simplicity, we're just going to assume we're just, well, it's GST. So to explain this one, first section is our assumption on drivers, and this is really where we're going to be putting in inputs. Now, it's pretty standard in any modeling that blue text is the figures that we're going to type in as the user, and then the black cells here, typically we don't touch these. These are all formula based. And so we don't really want to meddle with any of this. We really just want to put all our assumptions in at the top here and let the spreadsheet do all the work. So first up is just some time periods, some days, months, and the model will pull these down to do certain calculations. We don't really need to do anything with those. Big one here for this one are the revenue assumptions. So for example, this is a construction business or a trade business, and they've got some residential projects, some contract builder projects, and then some commercial or some council projects, and they're basically forecasting out our monthly revenue from these jobs. And the strategy here was sort of they were all residential, and then they want to start moving into more commercial work. So we've got a bit of a draft forecast here, and we can have a look what this is. This comes out of. So that's a key driver here. The other key sort of figures are going to be our operating cost assumptions. The big one is our gross margin. So gross profit margin starting at 31%. I mean, it's gradually ticking up here, and I hope they'll be able to ramp that up, and once they achieve certain efficiencies and start doing the right type of jobs, gradually improve that profit margin. If you're not quite sure what gross margin means, or this is getting a bit complicated. This is a pretty advanced topic, so possibly go and check out some other videos to understand these concepts first. But assuming we're on board with that, that's going to be our gross profit. So that's what's left after all the direct costs of doing a job. So if we did some residential work, we'd have material bills, we would maybe have some hiring of plant equipment to use on a job, and we would have subcontractors or wages for our team on the tools actually doing the work. And so after those costs, we're left with a gross margin of 31%. Other key figures we're going to forecast out are the rent or our lease. So typically we will know what that is. We probably have a lease document there which we can model that off. Overheads, we've got that in a fixed value of 12 grand a month. And your overheads are just, everything else, right? Your insurance, your advertising, marketing, bank fees, accounting fees, motor vehicle costs, licenses, everything else. But I've got a line here just working that out as a percentage of revenue. Typically, these will stay fairly fixed as you grow or scale, and hopefully as over time, this percentage here should actually drop as we achieve operating leverage. So we're growing the business, but our fixed overheads hopefully will become a smaller and smaller percentage of them over time, and that's really how ramp profits are. Other key figures, wages for employees. In this case, we just had one admin staff here, and all the other wages are sort of captured in that gross margin figure. And then the directors or the owners, they weren't going to draw a wage initially as they started the business, and then over time they were going to, as cash flow allowed, they're going to start drawing some wages out. Some tax assumptions. We've got this is a small business, so we've got a company tax rate of 25%. And the tax rate is actually paid, it's 0% really in the first year. You're going to be accruing a tax expense, but you're not actually going to pay it because we don't actually have to lodge a tax return until 11 months later sometimes. And so at the moment we're factoring in the tax, but we're not actually paying it yet. That's why that's 0, but that would change in subsequent years. Working capital assumptions. This is a really big one, and it is sort of a little bit more, you need to think about this one to make sense of it. Well, let's just work through this. The first one is receivable days. And this is an average figure of how long it takes to get paid. So if you think about that, 14 days means that we have, sorry about that, the camera just dropped out for a minute. We're back in line now. We're just talking about receivable days. And so this here is an average figure, 14 days. And what that means is your invoice terms, when you finish a job and you hand an invoice to your customer, they've got on average 14 days to pay. And what that means is that's going to delay the cash hitting our bank by 14 days. So that's one thing we need to think about in terms of the timing of cash flows. Second thing we need to think about is what's called WIP, or work in progress. This is pretty common. This is pretty common with any sort of construction business, or even like accountants like me. We would have WIP days as well, where you start a job and it takes a certain amount of days to finish it, and once you finish, then you send the invoice. There's all sorts of complexities with, billing up front or billing partway through. But in this example here, we're saying the WIP days is 25, which if you think about it, we start the job, 25 days of work, we finish, then we invoice, and then another 14 days until we actually get our money. So this is really delaying the time that we actually bank our cash. And then the other one in the other direction is payable days, and that we've got an average figure of 24 in there. What that means is if we get a bill from a contractor or a supplier, we've normally got 24 days before that falls due. So the combination of these three levers here will really impact our timing and our cash flow. So super important. Some other assumptions here, we've just got a depreciation rate of 15% of our fixed assets, so plant, equipment, and vehicles, that sort of stuff. That's really just an accounting figure. It doesn't really impact the cash itself. New CapEx. So CapEx is capital expenditure. In this scenario here, we're buying a business, right? So when we buy the business at the start, it's 150 grand worth of trucks and plant and equipment, and we're not actually investing in any more or new sort of equipment throughout this forecast period, but we might in the future. And then goodwill on acquisition, that's just the balance of the business purchase. You would only ever have this in there if you were buying a business. And then the financing assumptions, so how are we actually going to pay for it, for all of this? Where does the cash come from? In this case, coming from two places. One is an issue of equity, so we're issuing shares in the new company in this line here. And part of the point of this model was to see when we could start buying out the existing owner. And so here we're actually repurchasing shares, doing a share buyback. Dividends paid, we've just got that as 0 for the moment, but if you're paying dividends, that would go in here. Term debt issued, so this is like a business loan. So if you see here, with these two figures here, total is 550, and that's what we use to actually buy the business. So part equity, part debt. And then we've got the debt being repaid here monthly. And we've got the interest rate that the bank is charging on that debt. The other piece of debt that we might want to use is a line of credit or revolving facility. So it's like an overdraft account. So right now we've got a limit of 150. We can't pull out any more than that. That's our limit. Now it has an interest rate of 11.97 on any drawn funds. And this one, we're also modeling with the 1.5% fixed fee, which is basically levied on the full limit. Even if you don't spend it, the bank still wants to make money because they're sort of setting that money aside for you to use. So they're going to charge us 1.5%. I haven't got a debt to equity ratio covenant in there, but in short, for this one here, we look at a debt service coverage ratio. This is a covenant, and that means the bank may say you have to maintain a 3 times ratio to keep us happy. And in this case, what this means is your net income is 3 times more than the debt repayments. Okay? So if you drop below that, maybe the bank gets nervous. So these are the inputs we would be playing with to drive this model. So let's look at what it does. So the first statement is the income statement. So we've got revenues, which is just pulling down our revenue from our different projects. COGS, so cost of goods sold. This is all direct costs, and that gets us down to gross profit. And that profit is going to be based on that gross profit margin of 31%, improving slowly. Next comes out our overheads, our rent, and our wages. And you can see there no owner wages initially, and then the owner wages don't come yet. That gets us down to EBITDA, earnings before interest, tax, depreciation, and amortization. It's a pretty typical figure. A lot of valuations that people use. Depreciation comes out next, and that gets us down to earnings before interest and tax. We've got interest on the main business loan, and then we've got some interest on the overdraft facility. Then comes out tax, and that gets us down to net income. This is an interesting one because the tax in this case is actually levied before we pay this interest on the term loan, because that term loan is actually held off balance sheet by another entity, which is then essentially lending in. That's a complication for another reason, but we won't go into that in this video. Next up is the balance sheet. So this is recording our assets and our liabilities over time. And our short-term assets or our current assets, typically we've got 3 here. We've got cash. You can see initially there's no cash. As the business starts generating cash, that balance builds up. Trade and other receivables. This is all our outstanding invoices. So we're waiting to get paid from our customers. So that's a current asset. And then our WIP, our work in progress. Again, this is all our half completed jobs, which we're going to finish and build soon. Non-current assets are our plant and equipment, and this is slowly going down because this is a book value, so less depreciation. The cost of less depreciation. That's sort of an accounting value. These pieces of equipment will still have a market value, but this is book value. And then the purchase goodwill, that should really never change unless you go and buy another business. On the other side of the balance sheet is our liabilities here. So we've got trade payables, so that's all the bills that we have to pay to our suppliers or our contractors. Income tax payable, as we said, we're sort of incurring tax here, but we're not actually paying it yet. So it basically builds up here as a liability, and at the end of the year, we're going to have a 65 grand worth of tax to pay. But the cash hasn't come out yet, so we're sort of recorded here as a liability. And then the line of credit is the other current one. You can see here we do need to use that line of credit in the early months, so we're drawing on that balance and then we repay it, and it zeroes out at the same time that our cash builds up. If that makes sense. And then the other sort of balancing figure here is our stock or our shares. So that's our shareholders' equity. As you can see there, it's fixed until we start paying out the old owner, buying back his shares, and that's dropping that equity. We always want to put in a balance sheet check in here just to make sure the balance sheet does in fact balance, otherwise the whole line is broken. And that gets us down to a cash flow statement. So this is sort of the big one, and also the one that's a bit harder to understand. Income statement, pretty easy to understand. Most even non-business people will understand this. Balance sheet, again, a bit harder to understand, but you get your head around it. Cash flow statement can be a bit confusing, so let's just work through this. We've got and there's three sections to it. The first is cash from operating activities, so that's actually running the business. If we just look at month one here, a net income for the accounts is 15,000, and that should match back up to our net income on the income statement. What we're trying to do here is get from an accounting figure back to an actual cash figure, what's in the bank. And so there's several adjustments we need to make. So the first is we're going to add back depreciation. It's just a book expense. There's no cash involved, so that gets added back. And then here are the big ones, the working capital figures. So if we think about this, trade and other receivables, 77,000. That means we're waiting to get paid $77,000. We don't actually have the cash yet. It's going to probably get paid next month. So that's a negative. It comes off of our cash. Same with the WIP. That's in there at 95,000. That's saying we've got all this half completed work yet, but we haven't been paid for it yet. And then on the flip side of that is our trade payables. That's saying we've bought materials, we've got subcontractors working for us, but we don't have to pay them until the end of the month because, on their invoice, it could probably say, payable on the 30th. And so we've got some time. And so that's actually a benefit to our cash flow. And the other little benefit to our cash flow is our income tax. We don't have to pay it yet. So it's a benefit to our cash balance. But as you can see there, in month one, we're actually, nearly 60 grand in the hole in terms of cash. And that's because it's all tied up in our invoices and in our half-finished work. But you can see in month two where, it's jumped right up to 30 grand positive. That's because we're collecting all the money from last month. And then it sort of kind of evens out and averages out as we continue. So that's our cash from operating activities. Next is investing activities. This is when we're buying plant and equipment or buying the business in this case. So pretty empty here in many figures. The third one here is our financing activities. So we're issuing stock, which means we collect a bunch of cash, and we're buying back stock, which means we're paying out some cash. No dividends at the moment, but we do get a bunch of cash when we take out the bank loan, and then we lose cash as we repay the bank loan. And then same with that line of credit, we're going to borrow 60 grand on the line of credit because we don't have any cash in the first month. And then we slowly pay it back as our cash flow improves, and then it zeroes out because we're not using it anymore. And that'll all boil down to a net increase or decrease in our cash balance. So you can see we've really got no cash until we've paid off the line of credit, and then we start building up our closing cash balance there. And that figure here should hopefully 104 match back to our balance sheet. That's how these models work. They're just all connected. Building this model, there's a lot of supporting schedules that go into working out, how much we need to draw on the line of credit and how much cash there is, the debt schedule, all this stuff. There's a lot of sort of complex maths in there, which we don't need to go through. So I'm just going to hide that up. And at the bottom here, we want to, you can look at this and kind of get it, but it's unless you have a chart or a visual, it's really hard to understand what exactly is going on. And so that's where some charts come in handy. So the first one here is a monthly cash flow and cash balance chart. So this line here is the amount of cash that we hold in the bank, and that maps back to these figures here. And as you can see here, in the first month, we have an operating cash flow loss, which was that negative $58,000, and we funded that by drawing on the overdraft account. So we've got no cash in the bank until we start consistently hitting these positive cash flows, and the cash balance builds up. So we can see there in May is when we expect to stop having, we've repaid that line of credit, and we're building up the balance. This chart here is a debt service ratio, and as I've tried to explain, that debt service ratio is this figure here, and that's basically saying our net income is 4 times larger than our debt repayment for that month. And you can see it kind of is going along, and it drops here in September. So September we're down to 2.5. So that must be a weak profit month, and then it picks back up, and it's sort of back, coming back up, and that might be the point when we taper off on the commercial work and try to pick up those. Sorry, we taper off on the residential work, and we start picking up those, those commercial counselling jobs, and so there's a bit of a lull, and then we try to make our way back. So the bank might enforce something like a 3 times ratio. In a lot of small businesses, I don't think they would be doing that, but that's often you would see that in bigger businesses, that you would have to report to the bank and we're going to breach that. In this case here, there's a couple other graphs for the Queensland Building and Construction Commission, and they have certain financial requirements for their members. If you need a license with the QBCC, you're going to have to maintain a current ratio of at least 1, and a current ratio is talking about your current assets versus your current liabilities. So basically it's saying you've got to have enough cash and receivables to cover your short-term debts, otherwise your business is too illiquid and there's risk there. So it's got to be positive, and we can see here we should meet that. We're always above the line. The other thing the QBCC is concerned with is what's called a net tangible assets test, and that's essentially saying we've got enough assets on our balance sheet to support our revenues. So in this case, if we've got a business that's turning over $2 million, say, we need to maintain a certain amount of assets on our balance sheet, and that's net of any debts and liabilities. And so we might have to maintain at least 100 grand worth of net assets on our balance sheet, and this chart here is saying we should meet that and exceed that over time. And these are important because we would have to report to QBCC if we run with these, and our license might be at risk. So these are sort of our outputs here, and you would be reviewing this and looking at, the draw on the line of credit as one. The bank would be interested in this. You would obviously be interested in your operating cash flow, your cash in bank, your actual accounting profit of the business, and how quickly you might be able to buy out the old of its stage. So there's a bit of an overview of the three-statement model. This is something we can do. They do take a bit of work, but they're awesome, and they're also reusable. And we call this a rolling model because as we want to move forward, as January drops off, we add in February, and we keep rolling it forward, and we can put in our actual numbers here. Once we finish the month, we put in our actuals, and that'll also give us something to compare against as well. So I hope this was helpful or interesting. If you'd like to chat to us about doing one of these for your business, get in touch. Thanks, guys. See you next time.